Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we're going to be looking at Rowe Price. We have a new little member here of the Cyclical Investors Club named Yazzie, and she's hanging out of my office until she gets used to all the rest of us here in the house. So if you hear a little kitty jumping around, that's what's going on. And I've had tons and tons of questions about Rowe Price stock. This is one I do own that we bought in the Cyclical Investors Club during this summer. I haven't bought very many stocks using our core strategy the past 2 years. I went back and looked, and I think for the full cycle strategy, which is the main strategy, we've only bought 5 stocks in the past 2 years. So that's kind of how expensive everything has been. And those stocks were all financial stocks. We picked up Fidelity Information Services, Fiserv, and Global Payments Networks last year. And then after the banking crisis, we got UMBF, which is about flat, I think, since then. The other ones have been mixed. I think Fiserv has done well, where FIS has not done, and Global Payment Networks haven't done as well since we bought them. So we haven't really been missing out on too much, but the market was kind of getting to a point where I have kind of a dual outcome that I think's going to happen. I think we basically have kind of like a stagflation situation, and also, but that is pretty fragile, so that at various times we could have recessions that would kind of bring everything down, the economy and everything else. So last summer I was looking at, not last summer, this summer, back in July, TROW was coming off of this kind of boom during this is very similar to before 2008, by the way, when you go look at the historical comparisons. So it was coming down. I think we bought it at the end of July, maybe right in here somewhere. We're down about 20%, but it had made this big drop. Now I've owned TROW before. Owned it up here. We sold right at the peak, or right off of the peak. I think we sold right in January, like right in here, before it took the big drop. So we made like 20% on this toward the peak. I can actually tell you so we made 20%. We held it for just under a year, so that's not bad. And then we picked it up, and then we sold before the big giant drop. And I sold almost all of these. I wrote an article about all these financial stocks that I still held. I sold all of them at the end. I think I sold them right before this, like the middle of January of 2022, which is pretty much at the peak. So I did really well on a lot of these like you'll see AMP, BlackRock, Principal, Financial. So I owned these. And if you look, during the last cycle, we did really well with these. So TROW performed the lead. I didn't buy it until later. I didn't buy it in 2020. But if you look at these others, like Ameriprise, we did 260. These are realized returns, so they've been sold. We did 260%. Eaton Vance got bought out, and we got 161%. Lazard wasn't great, but we still got 30%. And Principal, I didn't buy that until the end of 2020, so not during the March sell-off. And we still got almost a 50% return. And then BlackRock, we got about an 80% return. And then BlackRock, we got like an 80% return. So we did pretty well. We did great actually with these. So definitely have some experience with these. I've owned TROW once before and got like a 20% return pretty quickly out of it too. Now I don't recommend all these stocks. Like when I first started the CIC, I did one on Ben Franklin, and so I want to show you what they look like, so we can show kind of what the danger might be for TROW. I think if TROW goes the way of Ben, where you have really this history, we can see a definite trend where earnings are just lower and lower. So I warned people about it when it looked pretty cheap down here. I think it was right at the beginning of 2021, and it's about flat since then. But I put an avoid video out on the YouTube channel, and because it looked super cheap, but with this downtrend, this long downtrend, that wasn't even really during like a financial situation, right? This 5 years here, that's just them losing business, probably to BlackRock or somebody like that. So TROW managed to avoid some of that, but they could be susceptible to it. And that, to me, is like, rather than the short-term price movements, the potential that this earnings decline could drag on is the real danger. Now, the cheaper you buy it, the more insurance you basically have against something like that happening, where, okay, maybe if it it doesn't ultimately work out, maybe you can get out and you don't lose that much money, right, in a few years. That's not the optimal outcome, but it can happen. And so I have metrics that I watch in order to watch for that, but it does become difficult when you're coming off a kind of a boom period and you're potentially going into like a recession. These metrics are going to look poor. So really it's going to take a couple years before the metrics I watch will give a clear signal. Look, the business, they're actually losing to competition, right? That's what I don't want to happen while I own the stock. And I think we don't know how that's going to turn out. But if you buy it cheap enough, then even if it does turn out that way, maybe you don't get like killed, right? Like the folks that kept holding up here when I sold, those guys are in trouble now, right? So I think I sold somewhere in January here. So if I would have kept holding, I'd be down 50%. So you don't want that to happen. If you do lose out, you want it to be like slow over time so you can definitely say, okay, this isn't working long term, and then have time to get out. So that's the danger. Now the opportunity is these guys look pretty cheap on almost every metric, because if they aren't losing to competition, basically. So because we can see earnings here, I'm using these more pessimistic 2024 earnings of $6. Well, before the pandemic, they earned 8, almost 9. So, we're going back to these earnings now. So that could just be something that they're going to bounce back at, and they're just in a down cycle. So if we have and they don't have any debt, I don't think. So yeah, they have like net cash. That doesn't necessarily mean the investments that they hold and things are not going to be subject to like higher interest rates and all those things. They probably don't make as much money off their stock funds as bonds, which might be what people are going to be using more when interest rates are higher. I mean, things like that. That's kind of, I briefly looked at the earnings report, this last one, and it looks like what you would read in a down cycle. We know the Magnificent Seven stocks have been doing well, but if you have funds that aren't weighted to those, especially if you have more growthy type stuff, TROW follows the QQQ quite closely. And I think if you took out the Magnificent Seven and looked at just smaller growth stocks in general, you would kind of see TROW's performance echo those. And my theory is it just has something to do with like their clients and the type of things that they're mostly looking into invest in, more growthy type things. So they're going to be more volatile. TROW's earnings are going to be more volatile because of that. So there's a lot of unknowns, and I decided to go ahead and take a stab at it. One, I have a lot of cash. This was last summer. Two, I kind of view these financial stocks in a basket because I take like 1% weighted positions, so they're not big positions. So if we do have a big downturn and everything really falls a lot, I'm going to be coming in and buying Ameriprise Financial. I'm going to be buying Principal probably, definitely be buying BlackRock when they're super duper cheap, right? Now TROW had already kind of fallen, and that doesn't mean it can't fall more. It certainly can, but these guys were still relatively pricey. I mean, and I sold BlackRock too. I actually sold it a little bit later. I sold it on this bounce here, I think, end of 2020. Yeah, I sold it on this bounce here, like in December, I think. And so that's been good because I missed out on all that downside. But and they've had earnings decline here. They haven't been as bad as TROW's, but definitely they could. And that's what the market's kind of starting to price in now. So if this continues, I'll be able to maybe buy BlackRock way down here, and then or Ameriprise. And I think these are all in the S&P 500. I haven't really stepped out of the S&P. So Ameriprise is not showing any signs of weakness yet at all. But they will if there is a sell-off. I'm kind of surprised they're holding up as well as they have been. You can see that their earnings can be deeply cyclical. In the Great Financial Crisis, they went from about, we'll call it 60 down to 12 or so. I mean, that's a big decline. So if they do decline, there will be probably some opportunities to buy it really cheap. And you can see that opportunity in TROW just looks like it came a little sooner, all other things being equal. They aren't usually always all equal. But you can see definitely this early weakness brought the stock down a lot. So I don't know exactly what's going to happen here. Now, but in terms of valuation, so I only assume like a 7% earnings growth rate for them, which is totally doable if they stop declining, basically, and then recover pretty quickly. So they might decline more and then recover, and then after that, get that 7%. So it's not, I'm not figuring anything like super crazy, but this does kind of figure that earnings will decline probably more first and then recover, right? So even using that, you get a 10-year CAGR of 8.5%, which 8 is my threshold. So just on a basic earnings and earnings growth estimate, it looks like a buy here. Using my recession method, I think this is what we used when we bought it. It's a little bit higher, but right in this range. This assumes earnings will come back and start growing again and won't just continue down forever. That doesn't mean they can't continue down next year. So the trick is, so I'm just holding this now basically because I bought it in the summer. I didn't know kind of my base. It's a little tricky because my base case is we probably have like an extended bear market and a recession. But we could also just have had stagflation and kind of maybe a slowdown, and just kind of muddle along. I think in that situation, TROW looks pretty good. But we're getting in the fall here, and the market's starting to get more jittery. And even though GDP came in really good, I think everybody sees that recession risk right around the corner, and that would be pretty tough for everybody. So for new money, what I'm telling people now is I would watch the momentum. So you can use like a 200-day moving average or whatever you like. I like to use, I have access to Seeking Alpha's premium service, so I get to see their momentum scores, and that's an easy way for me to look at that. And so it's a D+. I like to see this at a B-. So if the momentum shifted positive, if they got this up to like a B-, while at the same time it was under, say, $115, or depending how strict you want to be, $100. Let's just say if it was under $100 and the momentum had shifted positive, that would probably be a good sign to get in. The thing that I would be watching longer term are the 3-year revenue growth rate. Can't really see it right here. So this is cumulative 3 years. Now, this would normally be something when it's this low, which is basically kind of flat over a 3-year time period. If you divide this by 3, it's like 1% or something. But I know we were coming off of this big upcycle. And now we're getting far enough along where when you look back 3 years, you're looking near the peak, right? So you're looking back at 2020. So you're looking at revenues that are coming in here or maybe here, and they're a little bit lower than during this bump. So I would say probably that 3-year revenue number isn't going to be too useful until we get to about 2025, so in like 2 years, because then we're going to be comparing this time period. And if we're still negative at this time period and we haven't had like a bad recession, that probably means like competition and just industry dynamics, or however they're running the company, isn't likely to produce the type of growth that you're going to need. Now, if we have a bad recession, then all this stuff can get worse. So you have to kind of play it a little bit. If we had a recession here, you might have to wait till 2026 before it would say. But hopefully, I don't think it's the type of business that's just totally going to fall off of a cliff. I mean, if you look at Ben, now the market now expects them to fall off a cliff right here, but who knows? I mean, we'll see what those analysts think. But over time, you see this is like a slow decline. You get some up years. They got a bump from COVID too and stimulus, so it's not like a straight line down. So, if you bought during this initial dip, let's say, you're gonna, and then you notice after these 3 years, revenues suck. Well, if you got in here, I mean, you could sell it. Actually, you still would have had like a 7% profit. So if you would have sold somewhere in here after you realized, oh, whoops, things aren't going so great, you would have broke like even after 3 years. Now, you would have gotten outperformed by the market, but you wouldn't have taken like a gigantic loss, right? So that's what we would be watching for, and I don't know how that's going to turn out. But I do know that if TROW's earnings improve and earnings growth comes back, the stock price will rise a lot because it's cheap. It's at a 12 PE, and if you get 7% growth on a 12 PE, you're going to do really good. And probably coming off a trough, the earnings growth is going to grow faster for a couple years, right? That 7% is like the long-term average. And you can just see generally over the long term, they have a pretty solid trend. And I think they're going to have some tricky times, but, keep an eye on it. If it looks like it's bottomed, that momentum shifts up, and earnings haven't completely been annihilated, then that will be a good time to step in and take a small position and then just hold it through the next cycle. They also do pay a good dividend. See, I bought it when it was 5%. It's 5.5. So this is giving you the same dividend as cash, and I would expect them to do pretty much all they can. I think they may be a dividend aristocrat and things, so they know that their investor base are dividend investors, and that they're gonna, if they need to fire people and cut expenses, they'll probably do that before they cut the dividend. And so that would be, this kind of gives you a little bit of insurance. So if it is flat for 4 years or something, or down a little bit, you got that 5% rolling in during that time to at least kind of cushion that blow. You kind of see that with Ben too. I mean, I think they pay a dividend. I think they still pay their dividend. So it's been kind of flat, but they haven't lowered it. So these guys have been getting, 3 to 5% this time. Now, so if you bought it on this dip, let's just say you bought it in 2020. I didn't buy it because I didn't like the long-term trend. You're making 13% a year. That's not so bad. I don't think that's going to last, but at least you get kind of that insurance. And I think you'll get the same kind of dividend insurance with TROW. So I wouldn't be like reinvesting the dividend. I would be taking it out as kind of like, okay, this is my insurance in case it all goes wrong, 5 years from now and they just go nowhere. That dividend can make up for a lot in those situations. So let's, if you bought this one way back here and you had no clue how choppy it would just be forever, you still made 2% because they paid out so much of their money to you, 2% a year, which is not good. But again, the first rule of investing is not to lose money. So I thought TROW set up a lot better for the not to lose money bet while the market was still kind of high than some of the more volatile ones, even like a BlackRock or whatever. So that's kind of a complicated analysis for TROW, but I think it's a complicated situation. I think it's one of the ones to, partly because of that dividend, it's already sold off, so you can buy it earlier and then save some dry powder. If you make sure you have cash, I mean, if I didn't have any cash, I wouldn't be buying TROW right now. But when I have like 45% cash, I know I can keep buying other stocks, even similar stocks, if the market does really crash. Then that's one I'm willing to kind of take a stab at. I really haven't bought very many stocks using this which is my core strategy for like 2 years now. So, which is, you don't have to buy stocks every, more than that every 2 years, as long as you're willing to buy when the market sells off. But yeah, it was a little bit of a risk, a little bit against kind of my primary thoughts at the macro, but I could be wrong about the macro. So every now and then, if you see something that has a good risk reward, even though it might not be, the where I'm leaning generally, sometimes where I'm leaning is wrong. Usually I'm more defensive than the rest of the market. So that's kind of the story behind it, how I'm thinking about it, how I think maybe other investors should think about it. I wouldn't get too excited buying it now. I mean, people are probably it just took a big dive, so usually people get excited. They think they're getting a great deal, and they might be, but it's not as crystal clear and easy as it seems. If you look at Ben, those guys have been holding for 15 years and basically been flat. So that could happen with TROW too, and that's what we want to watch out for. But I do think it sets up reasonably well, but at this point that we know it's selling down, wait for that momentum to start coming up, and then that's when I would take a stab at it if I didn't already own it. Okay, that is the video this week. Obviously, this isn't investing advice, just like always. I'm just explaining what I'm doing. If you want to join the Full Cyclical Investors Club, there's a link down below. If you want to request a stock for me to analyze, I will analyze that. If it's in the S&P 500, I'll post it here. On YouTube for free, and if it's not, I post those on Patreon, which is $5 a month, and you get a big discount to the full service if you join the Patreon. And I will see everyone later.